Good morning, everybody. Kirk Spano, and it is June 6th, 2022, exactly 12 days before I leave for the World Series of Poker. I want to cover something that I think is very important today that I have been pounding on now for months, and this is the generational opportunity to invest in small cap stocks. And I say that as somebody who has been a small cap stock investor for a very long time, and over the course of my career, and really not the first couple of years because I was slinging mutual funds mostly, but starting in the early 2000s until recently, I have averaged a 10-bagger almost every year of my career. Now, they've come in hunks sometime, and doesn't mean I get one every year. There's been years where a stock that I owned hit the 10x mark along with 4 or 5 other stocks. I have been in Google, Facebook, and Apple and Microsoft and a lot of these stocks for the better part of 20 years and just got out of them several years ago or in the last several years. And now I look to get back into some of them because we're finally getting a mega cap technology stock correction on trader narratives that are utter bullshit. So this idea that technology and growth is going to go away is maybe the most foolish idea I've ever heard in my career. Technology has always led, growth has always led. Value stocks have never led for more than a cycle, and we are in the middle of one of those cycles. We're not even at the beginning of that cycle. The cycle started well over a year ago and has moved its way up the capital chain from the small caps to the mid caps and now the large caps. We'll see 2 or 3 more years of the value stocks doing pretty well, but only the companies that really have value. The categories are junk. And I say that because there are so many people out there saying, well, this is a value stock and that's a value stock because it's in that category. Bullshit. I think today is a good day to call a lot of bullshit because what you are seeing right now in the stock market is a rally across the board for the most part because the Fed hasn't started withdrawing liquidity yet. That starts on Wednesday. So I'm going to give you a warning here. And this is your last warning. You won't get another one. If you still own assets that are highly correlated to the S&P 500, S&P 500 companies that will go down when the panic selling starts on the S&P 500 index funds, then you are likely to take a big loss on those companies, at least in the intermediate term. Now, if you are a buy and hold forever person, that's fine. But once again, I would urge you to not own companies that are zombies, not own companies that offer very little in the way of growth and have dividend payments that may or may not be sustainable. You can figure that out pretty easy by looking at the debt of a company and then taking a look at its growth. And if a company has a lot of debt or pension obligations or a combination thereof, and they don't have any growth, those companies are eventually going to be screwed. Might not get screwed for 4, 5, 6 years. You might be able to keep getting the income, but at some point the market will recognize it. And large caps are very efficient. They don't stray from their index too often. So when those stocks start to come down, and I think the first wave is upon us, they won't come back. A lot of them will have a second wave down when they try to refinance themselves to keep the zombies alive, to keep them wandering around with their arms out and their eyes glazed and the scars. I estimate there's around 200 companies on the S&P 500 that won't be there by the end of the decade. That doesn't mean they're going to crash tomorrow. They might, then they might bounce back, and then they go lower yet again down the road. Remember, the Fed bailed out the entire market 2 years ago. Everything. Trillions of dollars. They bought corporate bonds. They allowed American companies to refinance their debt. And that debt will come due again starting in about 3 to 4 years. So a question you should ask yourself is, are you going to rely on the kindness of the Fed to bail them out again? I don't think it's going to happen. I think these companies were given notice that they better change themselves. And a lot of them aren't doing it. And many of them are doing it, but they're going to have to shrink. And investors hate that. So as their business models change, and they lay people off and they bring in more robots and they start to do things differently and their sales drop just because of the type of business they're in and their margins stay about the same and they don't produce more excess free cash flow to pay down their debts, they're zombies. Just chop along and chop along and chop along. And eventually their market caps will fall from 100 billion to 80 billion, to 60 billion, to 40 billion, to 20 billion, and then they get kicked off the S&P 500 because around 20 billion is what you need to maintain at this point. And there's a lot of small and mid-cap companies that are growing so fast that it's pretty easy to project them out to 20 and 30 and 40 and $50 billion market caps in the next 4, 5, 6, 7 years. Now, we have the reality of inflation right now. And I would strongly argue that it's not due to the Fed, because why on earth wouldn't we want to have high demand? That means people are living well. Almost everything is tied to oil, and I've showed the charts and the statistics before, and supply chains. Supply chains are moving, but it's going to take a few more years. Saudi Arabians are trying to squeeze as much money out of the end of the oil age, and we're in the beginning of the end. The end of the end is way out there. And the world hasn't come to the point yet where there's panic pumping. What is panic pumping? Panic pumping is when countries and companies start to produce as much as they can when they start to see demand turning over. And that, my friends, is only 5 or 6 years away. And they'll see it ahead of time. We've talked through this before too. Very easy to see the EVs are coming in a big, big way. The ignoramuses and flunkies who are trying to say that we don't have enough metals to do it and materials are nuts. There's so much lithium and other metals on the planet. And now that batteries are using iron and fewer rare earth metals, this is just a typical scaling up process. Take a few years. So between 2022 and 2026, the oil producers, until there's panic pumping, will have some pricing power. But that doesn't mean the price of oil is going to go up much anymore. Canada just told us that they can send us 900,000 extra barrels of oil per day by 2024. So what does that mean for us? Where do we invest? Do we chase oil stocks into their peak, or do we look for other investments? Do we look for companies that can make money on the changes in the energy system? Do we look for companies that can use technology to help industry and commerce? What do we look for? Do we follow the trader narratives of today? Do we try to make that next 10 or 20% because, oh my God, that would feel good right now? Or do we say, hey, I really am a long-term investor. I really am looking at what's 3, 4, 5 years out, and I want to catch those hockey sticks. Every one of you should have some money allocated for growth. If you're a retiree, maybe it's 20% of your money. If you're my age, it should probably be 80% of your money. And then your risk tolerance and financial circumstances everywhere in there. So all these ideas are based on what is the world going to look like in 7 years, 5, 6, 7 years, and the idea that the market will recognize it ahead of time, like it always does. And it'll run through the prices in both directions, above equilibrium, below equilibrium, above fair value, below fair value. And right now, in the small caps and SPACs, we are hugely below fair value on dozens and dozens of companies. There's an idea that small cap investing is more risky than large cap investing. The data certainly does not show that. What the data shows is that small cap investing has outperformed large cap investing for most of history, except for periods of several years at a time. And we're in one of those, and it's about to change. We've seen this happen once before. It's happening again right now. Unless we start putting Social Security money into the S&P 500 or Russell 1000 or something, the small caps are about to start outperforming the large caps, and the mid caps especially will outperform as well, because they don't come with the small cap stigma of, oh my God, that's higher risk, even though nothing in 100 years says that. The only place the small caps are more risky is during a recession, which we might have coming, or if they have a particular business shock that knocks them off track and they don't have the finances to deal with it. Some small cap companies have the finances, others don't. That's where screening and analysis comes in. If we can find companies that are sitting on big mountains of cash, like most of the SPACs, or that have big free cash flow and low debt or no debt, those are the companies that come out of this sort of thing roaring. Now, you don't buy the small cap index because that includes all the cash poor and debt laden small cap companies. You cherry pick them. You should never invest in a small cap index. Small caps are inefficient in the market. What does that mean? That means that because institutions aren't necessarily investing in them yet, because of the criteria they follow, because they're largely impacted by retail traders and hedge funds, madness of crowds, they can get whipped around. Well, when those companies that you're watching get whipped around and they get really cheap, that's like somebody handing you a present. Hey, we just beat this up. Why don't we leave it here? If you know that it's a good company and you know that that price is wrong, it was just vulnerable because of the market, then you can say this is a gift. When you take a look at a company like Ametis, which I tweeted about today, and you say, Why has institutional ownership moved up so much in the last 6 months? Might be because they're onto something. And as soon as that float is tight enough, the traders can't whip it around anymore, and the retail crowd starts to see it go up, and they're like, oh my God, it's going up, I better buy it. That momentum gets pretty strong to the point where it'll go from undervalued to fairly valued to overvalued. And while it's overvalued, the traders come back in and they start giving you bullshit narratives about why it's going to go to the moon. And that's about when you want to start scaling out, taking your profits. Warren Buffett, Peter Lynch, Charlie Munger, they've all talked about small cap investing. They all wish they could do it. They can't because they manage so much money that they would change the price themselves. So last week I talked about the Russell update. I'm pretty sure I'm missing one company in here. Planet Labs did in fact get added to the Russell 2000, so did Ginkgo Bioworks. And I thought the Satellogic, Inspire Global, and Black Sky would all get on the microcap index, which isn't that consequential. The Satellogic, Inspire Global got moved on to the Russell 2000. Now, the thing about the Russell 2000 is that they are going to update it every Friday until the end of the month. So their preliminary list isn't final yet. Black Sky and Heron Therapeutics got added to the microcap. Pretty sure Heron stays there. Black Sky, though, is big enough to be on the Russell 2000 right now, and they might get bumped up. We'll see. Why is that important? Because all the people who are buying IWM, which you shouldn't do, but a lot of people do, that forces Russell 2000 to add these stocks to the holdings and all the other copycat ETFs and mutual funds. So suddenly there's going to be an influx of institutional investor interest, institutional buying on Planet and Ginkgo and Satellogic and Spire, shrinking the float. Meaning that once people get over their emotional, oh, I hate this because it went down, and it turns into, oh, look, it's going up, I should jump in, and FOMO, these stocks will go up. So inclusion in the Russell 2000 is the first step. As these companies start to approach 20 billion, and some of them will in the next few years, then there's a second wave as speculation about inclusion into the SP 500 happens. I wouldn't really expect any of these in the next 3 years to get there, but 4, 5, 6 years for sure. A couple other companies of note. And something I want you to really think about. Charlie Munger has had a quote about this. When you look at a company, what you're trying to find is something that the rest of the market doesn't appreciate, that the rest of the market isn't valuing, an asset or a growth stream that the market assigns no value to. That's how I found MP Materials when it was still SPAC, because people were like, oh, well, this is the old Moly Corp. It's just a mountain of rare earth metals. It's not worth very much. But the reality is that A, it was worth a lot, and B, MP Materials is ramping up processing capacity so that we don't have to send those rare earth metals over to China to be processed. You may hear that. That's my killer chihuahua, who apparently is yelling at the Amazon or FedEx guy, would be my guess. Liberty Sirius, which we've owned on and off. Hard to find a space in it in the portfolio, but it's at a big discount, and Berkshire Hathaway's one of the biggest investors. And why do they invest in it? It's because Sirius versus Liberty Sirius are different. Liberty Sirius owns most of Sirius, but also owns a hunk of Live Nation, and at one point owned a part of Formula One. I don't know if they've spun that out yet. And when you do the math, it's trading at around 30% discount. Basically, you're getting the Live Nation for free. Take a look at the chart on Live Nation. Pretty good chart, right? Not bad. Came down, probably go back up. AT&T, why did we own it? Yeah, the dividend was nice, but we knew that we were going to get shares in Warner Brothers. Turns out that we didn't have to do it the way we did it, but we didn't know that ahead of time. And Warner Brothers, and Paramount, now Netflix, are all pretty cheap versus their cash flows. With consolidation in that industry, expenses go down, revenues get consolidated, bam, suddenly you have more money for less expense. Palantir. Nobody values the companies that Palantir owns or has big investments in. So while everybody talks about, well, Palantir's government sales went down a little bit last quarter, and really it was just the growth rate went down a little bit. Nobody's talking about all the companies that Palantir has an investment in. One of them is Black Sky. Think about that. Palantir is basically a spy company, whether it's doing it for corporations or government, right? They parse data and information in a way that helps corporations, governments, right? Black Sky is one of their investments. Satellites. Don't you think that that's a pretty good dovetail? Palantir can steer them business and then basically what amounts to a kickback as the stock price goes up. Ginkgo Bioworks is like that too. Ginkgo Bioworks has 8 joint ventures, a very horizontal business model, which means that dozens and dozens and dozens of companies, small and big, right? Biogen is involved with them, and all kinds of companies you've never heard of. And as they develop things, and Ginkgo Bioworks just keeps building an amazing database of the biome and all the different things that work and don't work in biology. When somebody says, hey, we got an unmet need, we're going to develop a product, let us use your platform and your data, and here's what you're going to get. You're going to get cash now and equity for the future. Almost all the companies that I invest in have something that the market doesn't value, or they have some sort of a moat. The satellite companies, I've told you, have a huge moat. Eventually, the government tells other companies, there's enough satellites up there already. You can't launch. So between barriers to entry for competition and assets and growth that the market doesn't value, that's where you're going to get your biggest winners. It's also where you have a huge margin of safety. Because if somebody assigns a value of 0 to something that's worth something, can't go down, right? Not in the long run. Something isn't nothing. So that's what we're looking for. Here's what I believe. You can hear me now and believe me later if that's the way you want to be. But if you still have a phobia about SPACs, get over it. SPACs are just companies now once they've gone public. And a lot of them deserved to drop 25 to 50% because of the way the warrants and everything else were set up. But a lot of them dropped between 50 and 90%, which means that those companies are cheap if they're going to be around in a few years. One of our subscribers has pointed out 2 companies in the last few weeks, and one of them has been a while, and they're both in alternative energy. And that's the theme that you really need to think through. Because while I saw somebody on Facebook this weekend, and I gave him the talking to he needed, talking about how clean energy is ruining the energy system, I pointed out a whole bunch of facts that didn't matter to him. It was all about ideology and hating somebody. The fact is, there's only one way, really, to make the price of oil come down. That's to use less of it. So that means a lot more solar for the EVs that are all coming in 2026 and 2027. Based on, again, this is not speculation. Get it out of your head. The EVs coming is speculation. Demand is high and supply is going to catch up in the next 5 years because all the car companies are telling you that's what they're doing, and that's where they are putting their money. And that can't be changed. It's in their filings. It's in their buildings. It's where the checks are going. I don't know what else it would take to make people understand the EVs are the future of all passenger cars. Bigger vehicles could be hybrids and biofuels and things like that. And jet fuel, right? Ametis, jet fuel, pretty big deal because we're not going to see electric planes for a very long time. We'll probably see hydrogen planes before we see electric planes just because of weight. So right now, batteries are heavier than fuel. So there's a lot of beat up SPACs, and a lot of them are sitting on big piles of cash, which I alluded to earlier, is if you have a big pile of cash, your risk really isn't any higher than any other company that's just trying to produce or operate. Small cap, mid cap, big cap, doesn't matter. If you're cash rich, you have an advantage. If everything you're building is contracted out already and people are writing you checks to build it, Ametis, I mentioned them yet, then you really don't have that much risk because the bills are already paid. So a couple things that I thought were pretty interesting as I was doing my weekend reading. Did you know, and I didn't know this, that there is enough alternative energy, clean energy, mostly solar, about 80% solar, that's trying to get built and added to the grid, but they're having problems adding it to the grid because there's 8 companies that control the grid, and then the 35 biggest utilities control most of it, pushing back, slow walking it is what they're doing. There's enough clean energy projects out there right now to cover 80% of the electricity needs of the United States. So when somebody says we could never build enough solar to handle the electric needs of the United States, they have no idea what they're talking about. The problem is that the transmission lines aren't keeping up, and the basic, the controlling infrastructure isn't keeping up. I have a friend in that business. I've talked to you about him before. He says, coming. They're hiring people, the people are taking the jobs, and they're building and building and building. I do believe it's the biggest transition coming. It's the easiest one to see. So that'll be the other article that I try to write by tomorrow, is my approach to energy investing. Right? We own Kinder Morgan because gas pipelines are a big deal. But wait, they also are in carbon capture, carbon transport for carbon transfer, and potentially for hydrogen. That's why Occidental is a big deal. Well, if it doesn't invest in them for the oil and gas necessarily, He could do that with anybody. He could just buy more Chevron. But what he's getting with Occidental and Chevron are big carbon capture businesses and the possibilities for hydrogen. It's New Fortress Energy, hydrogen is the future, even though they have a really amazing liquefied natural gas technology. When the big money is pointing directly at what they want to be investing in for the future, follow the finger. It's like a dog. There's the bird, and they point. That bird's pretty much almost always there, right? Dogs don't make a lot of mistakes. Might not be able to catch the bird. What makes this all possible is the fourth industrial revolution technology, all the new technologies. Another article I'm writing is titled Demographics and Robots Are Destiny. These are the ways that you need to be looking. So if you own, and I'm going to pick on this one because somebody mentioned it to me or showed it to me this weekend. If you own Simon Property, you should sell it, because with tightening interest rates and credit, and the fact that with a handful of exceptions, their malls suck still and require tons of CapEx, they're going to dive again. Did you know that the only real estate investment trusts that outperformed the last 20 years were what? I mentioned it last week, I think. Storage and industrial. Those are the REITs that outperform. Pay the biggest income, have the most growth. There are some niches that also do well. Vici, right? Vici is awesome, right? Because people are always going to gamble. It's about as recession proof as you get. So I'm going to Vegas here in 12 days, and I'm going to play in the biggest senior event in history for World Series of Poker. And here we are, everybody's griping about gas prices. The world's going to hell, but everybody's got cash in their pockets. Go drop $1,000 on this. Think that through. It ain't so bad, folks. It's just another transition. And transitions are scary because emotionally we're all unstable. If you can wrap your head around your own head, what you're going to find is that the world of opportunity out there is so immense, especially in the United States, that if you want to make a lot of money over the next decade or two, you can. You have to run away from the trader narratives, because trading these stocks is like the worst thing that you can do. You're just looking for spots to accumulate. That's what you're looking for. And then you hold on to them for years and you read about the company over and over and over again. Don't just look at the screen, right? How many of you look at your stock prices every day? How many of you look at it every hour? Stop it. Stop it. Unless you are an active trader, and only about 20% of you probably at best should be, 80% of you should just be accumulating for holding through an entire cycle, long-term position trades, because that is where the biggest money is. If you want to look at your stock prices at night, see what it did that day, that's fine. That can help you with setting up your limit orders to buy. But if you were looking at I'll tell you what, I don't even have a trading screen up right now. And honestly, for several hours a day, I don't. Just like I only look at my emails 3 times a day. If you want to be efficient, if you want to make good decisions, stop inundating yourself with bad information, and time sucks. You want to know about a company that you own, go to their webpage and read something. Jim Rogers, most important advice he ever got, the best advice he ever got, he said. So he was sitting on an airplane or a train, I can't remember which one anymore. Some other investor guy from New York said, "Hey, where are you going?" Jim Rogers told him. Rogers says to him, "So what's the best advice you can give me about investing?" He said, "Read everything." Because 90% of the investors out there don't even read the company's own documents, much less industry magazines or media reports. Most people have such a superficial knowledge of what they're investing in that they just follow the red and green numbers. The red and green numbers are there to help you know when the market is being stupid, but you can only know if the market is being stupid if you know about your companies. Now, I know you get a lot of that from me, and I'm constantly fighting this whole trader narrative theme because it just doesn't help you unless you are a spectacular trader. And remember who the competition is in trading. It's a network of professionals who made enough money on Wall Street or other places that they can day trade their own account, that understand technical indicators really well, and supercomputers that trade so fast and so hard that the bionic man couldn't keep up. Your edge, this is the same as with poker or any game, basketball player, football player, doesn't matter. You got to look for your edge. Your edge is that you can wait for the good pitches. You can wait to buy your stocks and buy your ETFs until the prices say cheap. And it doesn't just happen with value stocks. It happens with growth stocks. It's happening right now with growth stocks. So anybody out there who's looking at Procter & Gamble, stop it. Just cut it out. That's an industry that's ripe for disruption too. You want a better investment than Procter & Gamble? What happens when the United States starts adding bidets? Already started to happen. Every house in America is going to have a bidet in 20 years. Mark my words. So stop looking at the red and green numbers during the day. If you're not a trader, you should cut it out. Go to pick them randomly, roll dice. I don't care, but read about your companies instead. If you have 10 minutes to quick look on your phone, is this company up 7% or down 4%, or is it red or green today? Stop it. Go reread their corporate report. Maybe you missed something. I don't have a bidet. Somebody says I have a bidet and it's 100% worth it. I don't have a bidet, and next place will. All right, wiping's a pain in the ass. So look to the future. Think about what's coming. Let that guide you. Right now, the gigantic value is in small caps, and mid caps are almost there. And when large caps finally get there, buy the most cash-rich companies with the highest growth. That's it. This game doesn't have to be any harder than that. I've made millions. I've made millions. I've made more money investing than I have working in my career. So these companies, these small caps, look to get into them. From the option standpoint, I don't think you want to be selling many options right now for puts. Why? Because these movements are pretty fast right now. I think you're just looking for spots to buy. I haven't added many puts lately. I am looking for spots to sell covered calls. And if you have large caps, especially in taxable accounts that are, highly appreciated, you should be looking for spots to sell covered calls to January. So you sell the January covered calls because they get bought next year, right? As a way of tax management. Sell the December and January covered calls because you get a lot of premium for that. And you can manage which side of the tax year it falls on, right? I was talking to somebody Saturday, and he had hundreds of thousands of dollars in embedded gains. So you got to figure out a way to trim back some positions, a couple in particular, without just getting wiped out by taxes. So that means spreading out, figuring out how to do things. So if you can let your stock go up another 10% and you get 10% in premium, right? What happened was you basically just paid the tax man with earnings versus selling today. So I say that right now is probably your last warning on large caps. All you have to do is look at what happened the last time the Fed tightened. And when idiots on the interwebs tell you that fighting the Fed is a good idea, or that don't fight the Fed is not factually supported, and I can show you 10 charts that's crap. I don't even know what those snake oil salesmen are trying to sell you sometimes when they say things like that. I mean, if the super rich aren't listening to them, to people like that, why would you? I've written reports for hedge funds. I've met billionaires. I've made money. I'm just telling you. And the next thing that I'm doing is I'm trying to put together big real estate deals, because on my radar is the fact that there's droughts all over the country. There's wildfires all over the country. And the places that don't suffer from drought and wildfire probably going to become much more valuable. And who cares why it's happening, right? I mean, it's climate change, but if you don't believe that, I don't care. The fact is there's fires and droughts. Make an investment that makes money from that and maybe helps the world. I think you can go back to last week's retirement income options. I don't even know that I'm going to write one this week. I'll take a look. If there's a couple trades out there, I'll throw them out. Yeah. If I'm not doing the trades, though, I'm not going to put it out there. If you have a question about a stock you own, just, post it in the comments down here. I own blah, blah, blah. What do you think? Right? And tell me how much you're up or down. But all these things that are in here already, just adjust the prices a little bit, right? Always ask for a little bit more. Always try to buy back for a little bit less. You'll notice I started doing some updates on the very short list. So I have the dividends programmed in using a different system. Very nice. Even have it in the dividends, in the ETFs, right? All the dividends are here. Dividends are here. I took it out of the growth because after I put it in the growth, there was like 7 stocks that had like a fraction of a dividend. Who cares? We don't invest in these for the dividend. This is gradually getting built out, the trackers, right? Some of these. This is the one I've paid the most attention to. And I thought I'd finish on Bitcoin. So Warren Buffett gave a little bit more explanation to his thoughts on Bitcoin. And it's the same thing as his argument on gold. It's not a productive asset. Here's the thing with Bitcoin. It is a legitimate store of value, and institutions and the rich are getting into it. At some point, it'll stop going up and just be range bound the way gold has been. Gold's going to drift higher because of scarcity over time, but so will Bitcoin, because there is no new Bitcoin and Bitcoins get lost. So where's Bitcoin going? I still think it's going to go to between 300 and 500,000. I think that's what makes the most sense. And I think the run to 200,000 100,000 for sure, but 200,000 over the next several years is pretty easy, actually. So the investor I talked to this weekend, he actually has around $6 million, it sounded like, and a third of it's in Bitcoin and Ethereum. I'm not telling you to do that. I'm just telling you that there's plenty of smart people with money who are using it as a generational store of value. And more importantly, I think what they're doing, and it's what I'm doing, is we're just waiting for the adoption to really kick in, shoot it up on that next shot up, and I'll take my profits, pay my 20% in taxes, and be done with it. Because I'd much rather own land for long-term multi-generational reasons. But Bitcoin is a heck of a position trade, and it's cheap right now. Now, if you'll remember, a year ago when it was 60 grand, 55, 60 grand, I said it's going to get back down to 30 and it might get down to 20. I showed the charts why. So here we are, a shade under 30,000 for Bitcoin, and that lower 20,000s looks pretty likely for a hot minute. But I still think you should be scaling in. I just buy a little bit every month. And then on the dips every now and then I throw a couple thousand more dollars at it. And I don't have much. Most of my Bitcoin I still have won playing poker online. So any questions? Somebody asked about Azure. It keeps going up. Well, that's good. If Azure goes back down to 12 or 13, then sell some cash secured puts and take a starter position. If it doesn't, oh well. But I do think it'll have its pullbacks. I don't think we have a technical reason to buy it right now. That trade we made in it a while back, right here, that's pretty good. I think these are just going to expire. That's nice, right? $1.25, 12. I mean, that's 10% in 2 months. By the way, the profit and loss on these, just so you understand how they get calculated, you don't calculate it against the premium. It's the premium divided by how much money you had to hold on the side, right? So if you have to hold $55 on the side to make $225, it's $225 into 55, minus what you buy it back for. So in this case, on these Twitter shares, I netted out $2.05, but the strike price was 55, right? Oh, that was a covered call. Yeah, we sold puts on Twitter too. I should look that up. We sold puts on Twitter too. Okay, so this is just a covered call. That was easy. That's free money. Puts, you have to hold cash. So I'll look up what the Twitter cash secured put trade was. Let's see here. Are you in here, Teresa? Teresa, how much should we make on the Twitter put? Like $1.50, $2? I'll look it up. So Bitcoin's up to 31,000 right now. Yeah, so if you bought it at 28 or 29 the last couple of weeks when I mentioned it, you're up. But doesn't mean you do anything with it right now, right? Wait for the bigger moves, unless it's really, you made $11 a share on the Twitter trade, and that's everything, right? That's the calls, the puts, and the shares, everything, yeah. So about 30 some odd percent in a couple of weeks. That's quite the story going on there with Twitter, huh? I don't know what Musk is trying to do. I don't know if he knows what he's trying to do. I worry that he's becoming less stable. He's never been stable. He's smart, right? And he's ahead of the game in a lot of places, but there's something up with him. I don't know what it is. I don't know what his game with Twitter is. I really don't. Is he suddenly trying to get a lower price? I don't understand. I just don't understand why he went about things the way he's going about things, if that was the case. Was this all a PR stunt? Well, if it was, it's probably going to cost him $1 billion. That's a heck of a PR stunt. That guy doesn't need to do that. So, in any case. All right, I'll let you all go, but I really need you to think about these small caps because you've only got a few more months to buy these at these kind of prices. By the end of the year, they're going to be going up, and the ones added to the Russell 2000 probably start going up sooner. The small cap index has been doing pretty well compared to the large cap index, and I think that is a harbinger of the future. I think you're going to see the small caps come racing out of this, right? And when I say the small caps, I mean the ones that we own, and probably some others that we don't. I'm not talking about the index, but there's some great opportunities in small caps right now. So, all right, have a good day. And I'm going to put out the energy article. So I want to talk about energy because that's just something you got to wrap your heads around. Everybody wants to scream oil, oil, oil. It ain't about oil. It's about getting away from oil. How is the shift away from oil going to create opportunities? That's what you need to know. All right, take care, everybody.